What's up, guys? It's Devin here. I get asked all the time, what is infinite banking? A lot of people call it the infinite banking concept, or IBC. In this video today, I'm going to explain exactly what it is in the simplest way possible so you can understand it. And then, more importantly, if you understand it, you can apply it in your life. And if you can apply it in your life, you can get ahead way faster with your wealth and your legacy and everything. So tune in, and if you haven't already, subscribe to my channel, hit the bell so you get notified when I put out these videos, and hit the like button. You'll get notified every time I put out more of these. So let's get into it. So the infinite banking concept, IBC, privatized banking, people have called it that as well. Really all it is, it's just taking back the banking function in your life. What does that mean? Taking back the banking function, becoming your own bank, as you're going to see above me. Really what that means is you're doing what you do with banks on a normal basis. And what does that start with? Well, what do you usually do with a bank? You put your money in it, right? You save your money inside of a bank. That's what we've been taught to do. We've been taught to take our hard-earned dollars and deposit them into the local bank. Chase, Wells Fargo, Bank of America, whatever it might be. So you save money inside of a bank. So the first part of the infinite banking concept is simply changing where your money goes first. Now, I said where it goes first, not where it goes indefinitely, just where it goes first. So most of us, again, we take our money, we put it inside of a local bank, and that's where we save our money. That's what we've been taught to do. And then we take that money and we use it for things in our lives, right? That's what most people do. That's like the first part of a banking function, is where your money goes, where it flows from your paychecks and where you save the money. So with the infinite banking concept, you're just changing one thing really, and that's where the money goes first. So instead of the money going into a bank, think about a bank. A regular bank, on average, you make 0.06% interest, which is almost an insult. It's like, why even pay me anything? Just give me zero. 0.06 is basically zero. So that's where we put our money. Into a local bank, we get paid 0.06%. The money is not protected against lawsuits or judgments. So if someone sues us and we have all of our money in a traditional bank, which is what we're taught to do, we can have all that money taken on judgments or lawsuits. And if we use that money inside the bank, we no longer earn that 0.06% interest, okay? So what I'm saying with the infinite banking concept is you're changing where the money goes first. So it goes into a place that instead of paying you 0.06%, it pays you 3.25% guaranteed. Go ahead and listen to that again. Instead of 0.06%, you're getting 3.25% tax-free. So if you think about that, that's kind of like earning 5 to 6% before taxes. So right there alone, it's already a far superior place for your money to go first. You put the money into a place that gives you 3.25% guaranteed. Plus, this place also gives you dividends. So the dividends aren't guaranteed. However, the companies we use for this have paid a dividend every single year for over 100 years. We're talking about through the Great Depression, World War I, World War II, swine flu, bird flu, COVID, you name it, any economy, these companies are paying dividends because they're profitable. When they're profitable, you share in those profits with a dividend. So instead of 0.06%, you're getting 3.25% plus dividends, which generally is going to come out to around 5 to 6% tax-free. So right there, just a far better place for your money to go first. Then you have to ask yourself, well, how much do I put into it then? And I will tell you this, there's a great book. It's back here on one of these sides of the bookshelf. It is The Richest Man in Babylon. And it says, one of the main pillars of wealth is to save at least 10% of every dollar you earn. So if you earn $1, save at least 10 cents. So you should start there. Put at least 10% of your total income, your savings, into this better vehicle, this infinite banking concept vehicle. Okay? So you're going to put at least 10%. So if you make $100,000 a year, you should be putting at least $10,000. It should be flowing there first instead of into the bank. Okay? Now, it's all relative because some people make more money. Some people don't make as much. So you should really put at least 10%, but really you should put as much as you can, as much as possible. Because think about this. Right now, what we do as Americans, as I just mentioned, is our money flows to the bank. If you make $100,000 a year, just for easy math, after taxes, you're probably somewhere around $70,000 of net income. That means that $70,000 a year is flowing to the bank that pays you 0.06%, that's not protected against lawsuits and judgments. And once you use that money, you stop earning 0.06%. So realistically, you should probably flow 70 grand to this infinite banking concept vehicle. Okay, we're going to get into exactly what that is. What it is, it's nothing more than a properly structured whole life insurance policy with a mutually owned company that pays dividends. Now you're probably thinking, wait, hold on. I've always heard that's the worst place to flow money. And you're probably thinking, yeah, buy term and invest the difference. You've heard that all the time. I'm not talking about a regular off-the-shelf whole life insurance policy. I'm talking about one that is designed for banking purposes, that has instant cash value, where if you put in, and these numbers are arbitrary, I'm just using this to keep it simple. If you put in $100,000 into a properly structured whole life insurance policy, you can have access to up to 90% of that immediately within the first 30 days. So think about that. You put in $100,000, it's guaranteed to grow at 3.25% plus dividends, tax-free, and then you can use up to 90% of it right away. Okay? So the first step, again, is finding out how much you can put into an infinite banking concept policy. Okay? A properly structured whole life insurance policy. So that's step one. We figure that out, what you can put in, it's based on your situation. Once it goes in there, step two is what to do with it. Okay? That's probably the most important thing. And I would tell you this, there's really three ways to use a policy. When you put money in, you can either use it to make more money, so use it to invest into anything you want to invest in. You can put money in, you can use it to buy things that you would normally buy from the bank, or you can put money in and pay debts off. Probably the most important thing is to pay debts off first, because you're losing money, you're losing your wealth to other people, to, Wells Fargo, Chase, whoever you have loans through, credit cards, car loans, all those kind of things. So step two is, what do you do with the money? So again, don't get caught up on these numbers, just focus on the concept. If we put in $100,000 into a properly structured policy, and if you can access to 90,000 of it right away, so you put in $100,000, this $100,000 is compounding and growing, tax-free, guaranteed. And then what you do, think of this as a circle. You're taking the money over to the other side of the circle to use it, okay? So you're using it over here to, let's say, pay off debts. Let's say you owe $90,000 on some debts. And let's say with those debts, it's credit cards, personal loans, student loans, whatever. And let's say the average of all those is about 20% interest. You're losing 20% interest to creditors. Once you pay them every single month, like most Americans do, that money's gone forever. You'll never get that money back, and you'll never get its ability to compound and grow. Okay? So with the infinite banking concept, all you're doing is, again, changing where the money goes first, step one. Step two, you're doing the same thing. It's in this policy. You're using it to pay the debt off. So let's say $90,000 of debt paid off. Now, all you're doing is you're completing the circle. You're getting your money back to your policy where you control it, where you can always have access to it. So think about this. Taking the money, you're paying the debts off. These debts had a payment every single month that you were paying on time. 20%, 25%, 15, 8, whatever the debts were. Let's again say they're average of 20. If you were paying these debts on time every single month without fail, you were paying the bank and everyone else that you're borrowing from 20% interest. If you simply take the payments you were making to them, now that they're paid off, and you pay that back to yourself, your policy, you're getting the 20% average that you used to give away, okay? You're keeping that money instead of losing it forever. And here's the beauty of it. When you used this money from the policy, you didn't actually remove it from the policy. See, what happened was your money is still sitting in this policy, compounding and growing tax-free. What happens is the insurance company will give you a loan using your money as collateral. So they're letting you borrow their money, which is an advance of your future death benefit. And they charge you an interest rate to do so. So right now, at the recording of this video, it's right around 5%. And that number doesn't change often because they're playing the long game with life insurance. People live a long time. They're not going to insure you if you're probably going to die soon. So what happens is they charge 5%, but inside the policy, if with dividends, if you're making 6%, you're making a 1% spread. So you're already making money with inside your policy while you use it. And if you pay these debts off and you pay yourself back, remember, complete the circle, you're getting 20% what you used to give away. So you're literally making money in two places. You're making the spread over here inside your policy, and you're recapturing 20% that you used to give away to everybody else. It's actually really simple. You're already doing this right now. You're putting money into a regular bank, step one. Then you're taking the money and paying the debts, step two. You're just not recapturing the money because once you pay your debts, the money is gone forever. You'll never get it back. And as I mentioned, you'll never get its ability to compound and grow. Stop this video right now, go to Google and type in compound interest. Albert Einstein, pretty sure he's a smart guy. He said that compound interest was the eighth wonder of the world. He who understands it, earns it. I just told you how to earn it. Put it into a policy. It's going to compound and grow, guaranteed for the rest of your life, even if you use it. So I just told you guys how to earn it. He also said, he who doesn't understand it pays it. That's what most people do. They put money in their traditional bank account, step one. Step two, they pay their debts. Money's gone forever. You guys are doing the same thing with infinite banking. You're putting the money into a policy, step one. Then you're using it, step two. You're not interrupting the guaranteed compound growth. And then you're just adding one extra step. You're just paying yourself back what you used to pay all the creditors. Here's the beauty of it. Inside your policy, this money is compounding and growing. Compound interest means you make interest on interest. So your money is continuing to go up. When you pay back the policy loan, so when you complete the circle, when you're paying down that policy loan, one, the money's immediately available to you again inside your policy. You control that money. So when you're completing that circle and making payments back to yourself, you actually have control of that money again. You can use it for whatever you want. But here's what's also happening. You're paying down the balance of that simple interest loan. It's 5%, like I said. So if you're paying down the balance, you're paying less interest to the insurance company for borrowing their money. So effectively, you pay less than 5% while your money continues to compound and grow. So do you see how your money's continuing to get bigger and the amount of interest you're paying continues to get smaller? You're widening the spread inside of your policy, all while you're just recapturing money that you used to give away to third-party creditors. So do you see how easy this is? It's not difficult. You're doing the same things today. You just have to change your mindset. You have to say, you know what? I've been taught whole life is a horrible place to put money, but I've been taught the wrong kind of whole life. I've been taught the whole life that is built for the death benefit. I'm not talking about death benefit here. I'm talking about living benefits, using a policy while you're alive. Think about what it's called. Life insurance, not death insurance. If it's structured properly, which is what me and my team do, it can and should be used while you're alive. And I just showed you guys a very simple, easy way how to do it. 1, change where your money goes first. 2, take the money and pay debts off. It's very important. If you get your debts paid off, you're recapturing all the money that you're losing right now, and that money will never stop compounding and growing. Step 3, again, is just to recapture the money. So this is very simple. You're not doing anything out of the ordinary. You're simply changing where your money goes first. You're using the money like you normally would, and then you're recapturing the money that you used to give away. Super simple, okay? So guys, you might be thinking to yourself, well, I don't really know how I would do that, the mechanics of it, which debts to pay off first, and all these different things. Very true. Here's what I would tell you. Have you talked with my team? Probably not. So in the actual description of this video, there is a link where you can register for a free training video where I give more visuals and kind of show you exactly how these debts get paid off, how you can buy cars and get back all the money for any car you'll ever buy, drive, and own. I mean, I've done this so many times. I've bought an Audi R8. I've bought a Porsche 911. I've purchased my wife's car. I've purchased 2 other SUVs using this concept, and I actually make money buying the cars because I'm the bank. So, guys, this is very, very simple once you understand the basics. In the description of this video, as mentioned, register for the training video. At the end of the video, you can schedule a call with my team. We will walk you through exactly how to do it in your situation. My team never sells life insurance. We do not do that. We explain how to use this concept in order to become wealthy through your own debts and expenses, how to use this to invest in different things outside of a policy and make more money, how to buy cars, how to buy things that you normally buy from the bank. We explain and show you how to do this. And then once you really understand it, you're like, gosh, this makes so much sense. Why wouldn't I do it? So then at that point, we help you do it. We set the policy up. We are all licensed agents. We are all practitioners. We all do this on a daily basis. I personally have 15 policies. I use them for everything in my life. So guys, I am excited to actually share with you guys exactly how this works in that video. Make sure you register for it. Watch it till the end, write down your questions, and then schedule a call. In this video, comment any questions you have as well. I'll make sure to get back to all of them. As I said at the beginning, if you are not subscribed to my channel, make sure to do that. Smash that like button and also hit the bell so that you get notified when I put these videos out. It's been an absolute pleasure. Until the next time, I love you guys. Peace.